In my last 10 years working as a financial planner, I have repeatedly seen people make this mistake. When they have strategies available to reduce their taxable income to minimize their tax, they always bring it right down to $18,200. After all, this is the figure you see on the ATO website and various tax calculators as a tax-free threshold, right? I'm here to tell you 18,200 is not the magical number, and you can have more taxable income and still pay zero tax. More importantly, I'm going to show you with 3 real-life examples how shifting your perspective on this can make a tangible difference in your finances. Are you ready? Let's dive in. First, if 18,200 is not the magical number, what is it? Enter 20,000. Zero tax. 21,000. Zero tax. 21,885. A little bit of tax. 21,884. Zero tax. We found the magical number. The $700 low-income tax offset perfectly negates the amount of personal income tax, resulting in your total tax liability being zero. If you want to know more about this tax offset, check out the link in the description box below or simply do a Google search. But you really don't need to because this is all done automatically by the ATO. So, 21,884 is the magical number. Unless you are also eligible for the seniors and pensioners tax offset. Well, to be eligible, you must be over the pension age, which is currently age 67 for those born after 31st of December 1956. Well, I won't get into the details of that in this video as my main audience tend to be a bit younger. So yeah, 21,884 is the magical number. Meet John, a uni student juggling studies and a part-time job. Jenny, a dedicated mom working part-time and saving for her first home. And Dennis, retired 10 years ago, sold an investment property after holding it for 20 years. They all share one common goal: to minimize their tax. There is something satisfying about reducing your taxable income to just the tax-free threshold so you pay zero tax. What's better, they all have strategies available to them to bring their taxable income down to the effective tax-free threshold. Before we get into the details, keep in mind this video is for educational purpose only, it's not financial advice. Your situation may be more complex than the examples. It's crucial to thoroughly research or consult a professional before applying these concepts. You see, the old John who still believes that 18,200 is a tax-free threshold might have scratched his head and wallet to find 3,800 worth of deductions to pay zero tax. Have you ever spent money on something you didn't really need just because it was tax deductible? I know I have. Well, now all he needs to find is $116 worth of deduction. Easy peasy. As for Jenny, after totaling up her usual deductions like work-related expenses, donations, and income protection premium of $5,000, she can reduce her taxable income down to $21,884 by making a personal deductible super contribution of $13,116 from her savings. She's already saving for her first home, so why not utilize the first home super saver scheme and pay zero tax for the year? If she hadn't known that the effective tax-free threshold is $21,884 instead of $18,200, she might have been tempted to make a larger personal deductible super contribution of $16,800, thinking she had cracked the code. However, what Jenny overlooks is that the first home super saver scheme only permits the release of up to $15,000 of her voluntary contributions from any one financial year. This means that the additional $1,800 she contributes is effectively locked in her superannuation, inaccessible until her retirement. For our lucky Dennis, even though this is a big year for him as he sold the investment property, he can still utilize the carry forward super contribution rule to make a larger personal deductible contribution and bring his income right down to the tax-free threshold and pay zero tax. Nada, nil, zero. How? You see, he held the investment property for more than 12 months. So he is eligible for the 50% capital gains tax exemption. This brings his taxable income down to $150,000. He has been retired for 10 years, and during those years, he had never made any super contributions. And as of 30th of June 2023, his total super balance is under $500,000. So, under the carry-forward super contribution rule, the maximum he can contribute and claim a tax deduction is $132,500. Since the effective tax-free threshold is $21,884, all he needs to contribute as deductible super contribution is $128,116. If he hadn't known the effective tax-free threshold is $21,884 instead of the $18,200, he might be tempted to make a larger personal deductible contribution of $131,800. But in reality, he would have ended up paying extra super contribution tax of $552.60 on the difference without reducing his personal income tax any further. That's quite a bit to digest with all these rules, numbers, and calculations, isn't it? If you have made this far, type in super in the comment below. This way I'll know how deep to dive into the numbers in future videos. Thank you so much for sticking around. I hope this is helpful in some way. I'll see you in the next one.